Right now, the biggest companies on Earth are spending $700 billion a year building artificial intelligence. To put that in perspective, that's more than the entire economy of Switzerland spent in 12 months on chips and data centers. The bet is simple, that AI will change everything. There's just one problem. Almost none of that money is coming back yet. So here's the question quietly terrifying Wall Street. Are we watching the dawn of a new era or the inflation of the biggest bubble in history? In June 2026, a single disappointing forecast from one chipmaker helped wipe out over $1 trillion and trigger a market-wide crash. Suddenly, the question everyone had been too excited to ask got very loud. In the next 10 minutes, we'll break down, in plain English, how AI took over the stock market, the $600 billion hole at the center of it, the strange circular money keeping it spinning, and the honest case for why this might not be a bubble at all. No hype, no doom, no financial advice, just the real picture. Start with the scale. For 2 years, the entire stock market had essentially one story: artificial intelligence. And a tiny handful of companies became the main characters. By late 2025, just the 5 largest companies made up around 30% of the entire S&P 500, the greatest concentration in half a century. One company, Nvidia, maker of the chips that train AI, ballooned past $4 trillion, larger than any single company in the history of the dot-com boom. The market's most watched valuation gauge climbed to a level not seen since the dot-com peak of the year 2000. In other words, more and more of everyone's money, your pension, your index fund, quietly became a bet on AI. So is that bet justified? Here's where it gets interesting. Because unlike the dot-com era, this boom is built on something very real: profit. When the dot-com bubble burst in 2000, many of the darlings had no earnings at all, just websites and dreams. Nvidia is the opposite. It pulls in well over $200 billion in revenue at gross margins above 70%. Numbers most companies can only fantasize about. And the giants pouring money into AI, Microsoft, Google, Amazon, and Meta, aren't fragile startups. They're some of the most profitable enterprises ever created, funding this largely from their own pockets. So if you want the case that this is not a bubble, it's strong. But, and it's a big but, there's a hole in the middle of the story, and it has a number, roughly $600 billion. Here's the problem. The amount being spent to build AI is enormous and growing. But the amount AI is actually earning from real customers paying for real products is far, far smaller. A respected analyst at the venture firm Sequoia tried to measure the gap, how much annual revenue the industry would need to justify all this spending. His estimate of the shortfall? Around $600 billion a year and widening. The evidence backs the worry. A 2025 study from MIT found that 95% of companies experimenting with generative AI were getting essentially zero return. And everyday consumers spend only about $12 billion a year on AI services. Spending like it's a revolution, earning like it's an experiment. Now the part that really raises eyebrows. Follow the money. Nvidia, the chipmaker, recently agreed to invest as much as $100 billion into OpenAI, the maker of ChatGPT. And what does OpenAI do with much of that money? It buys chips from Nvidia. Money goes out one door and comes back in another. Critics call this circular financing, where a company effectively funds its own customers, making demand look bigger than it really is. And it doesn't stop there. A web of deals now links Nvidia, Microsoft, OpenAI, and others, all investing in and buying from each other. 4 customers alone make up more than 60% of Nvidia's revenue. The last time the financial world saw deals this circular, at this scale, was the dot-com bubble. So let's ask it directly. Is this 1999 all over again? The parallels are loud. Sky-high valuations, a single dominant theme, money flooding into anything with the right buzzword. And there's a structural trap underneath. The chips at the heart of AI wear out and need replacing every 3 to 7 years. But the data centers housing them are financed like buildings that last 30. That mismatch creates a refinancing treadmill. You have to keep raising money just to stay still. The investor who famously called the 2008 housing crash, Michael Burry, warned in 2026 that this felt like the dying months of the dot-com era. The head of JP Morgan warned a lot of money could be lost. And the head of the world's largest asset manager said plainly, this race will produce bankruptcies. And then, in June 2026, the first crack appeared. It wasn't a catastrophe, it was a forecast. A major chip company guided its AI sales just slightly below what Wall Street hoped for. In a market priced for perfection, slightly below was enough. Chip stocks tumbled. Over $1 trillion evaporated in days. And for the first time in 2 years, the narrative flipped. From how high can AI go to, wait, how do we get out? The mood had changed. The question was no longer whether the spending was huge. It was whether it would ever pay off. But here's the honest counterweight. Because this channel doesn't deal in doom. Bubbles are obvious only in hindsight. And there are real reasons this time could be different. The leaders are genuinely enormously profitable. They could survive a downturn that would have killed a 1999 startup. And remember, even after the dot-com bubble burst, the internet went on to create the most valuable companies in history. The bubble popping didn't mean the technology was fake. A bubble in valuation doesn't even always mean a crash. Sometimes it just means years of moving sideways while earnings catch up. The truth is, no one, not Burry, not the CEOs, not me, knows for certain. So what do you do with all this? 3 honest things. 1, understand what you actually own. If you hold an index fund, you already own a big bet on AI, whether you meant to or not. 2, concentration cuts both ways. It supercharges the gains and it deepens the falls. 3, the people who survive bubbles in either direction are the ones who know their own time horizon and risk tolerance before the emotion hits. This is education, not financial advice. The goal isn't to predict the top, it's to understand the game. So, is the AI bubble bursting? The honest answer, it has real bubble symptoms. Extreme concentration, a $600 billion revenue gap, and circular money that echoes 1999. But it also has something 1999 never did. Real, massive profits underneath. Whether that's enough is the trillion-dollar question of our time. If this helped the biggest debate in markets finally make sense, that's exactly what Compound Compass is for. Subscribe and tell me below, real revolution or the biggest bubble in history? See you in the next